Hi, everybody. This is Mike Felix from Omega Point, and I'd like to thank you for joining the webinar today titled Introducing the Wolfe QES U.S. Broad Equity Model in Omega Point. Wolfe's newest model provides investors with access to several alternative factors that are especially relevant to the current market environment, including hedge fund crowding, short interest rates, oil prices, and many more. But first, before we get started, it's my pleasure to introduce today's presenters, Hallie Martin from Wolfe Research and Omer Cedar from Omega Point. Hallie Martin leads the risk and investment solutions efforts within the QES team at Wolfe Research. Previously, she was at Deutsche Bank as the head of the Delta One strategy research, and she focused on ETFs, custom baskets, indices, and futures with a specialization in risk management and positioning. Our other presenter is Omer Cedar. He's the CEO and co-founder of Omega Point. And previously, Omer was SVP at Two Sigma Investments, where he was responsible for research and modeling, product development and relationship management, as well as managing their risk guard systems and model development. Just a few words about the presentation today and the format. The presentation today should last about 35 minutes or so. And once we conclude, we're going to dive into any questions that you may have. Please, during the presentation, feel free to submit your questions via the interface, the GoToWebinar interface on the right-hand side of the screen. Type them in, and I'll make sure that they get over to Omer and Hallie so that they can address them at the conclusion of the presentation. So with that out of the way, I'd love to hand it over to Hallie Martin.
Thank you, Mike. On today's agenda, we're going to introduce Wolfe QES's new U.S. equity risk model that includes next-generation factors and also has a unique methodology for calculating stock exposures to factors. We're going to take a closer look at our hedge fund crowding and short interest factors and look at an analysis of hedge fund 13F portfolios via the Omega Point platform. Wolfe QES's broad U.S. equity model includes both traditional and next-generation factors. We have the common technical factors that you'll find in most risk models, as well as the typical fundamental factors representing growth, value, leverage, and other fundamental signals. Additionally, we've added next-generation factors into this risk model, covering both macro signals as well as investor positioning. On the macro side, we've added interest rates, so sensitivity of stocks and portfolios to changes in U.S. Treasury rates, equivalent to the 10-year, and additionally, beta to oil prices, specifically WTI futures, after controlling for beta to the market. On the positioning front, we've introduced a hedge fund crowding factor and a short interest factor. These factors combined represent where we think positioning is across the broad hedge fund industry. The hedge fund crowding factor is 13S based and represents the long portfolio of equity long short managers, and the short interest portfolio represents the short side of the portfolio. Wolfe QES's U.S. broad equity model has significant explanatory power across portfolios. To analyze the explanatory power of this model, we look at the opportunity set. The opportunity set is the long-short portfolio that's signal-weighted by the 1-month forward return of stocks in the risk estimation universe. So basically, this is the portfolio you would own if you had perfect foresight about the month ahead. We then run that portfolio through our risk model to assess the percent of dispersion that was explained by the factors in our model. And you can see, for example, in March 2020, the systematic factors collectively explained over 50% of the return dispersion across U.S. equities between sectors and styles. The next generation factors, specifically interest rates, oil prices, hedge fund crowding, and short interest, all did have significant explanatory power in the post-global financial crisis period. You can see at the bottom of this chart that interest rates in particular have had increasing explanatory power in recent years. Oil prices have had significant explanatory power back during the financial crisis, again in 2015 and 16, and a little bit more recently. Hedge fund crowding and short interest overall, on average, have lower explanatory power than the macro factors. However, during specific periods in time, these do have very strong explanatory power. This analysis is based on monthly returns, and in particular for hedge fund crowding and short interest, which can move very quickly in a matter of days, we find that they have even more explanatory power during short periods of time where they're relevant, for example, in March 2020. One thing that differentiates Wolfe QES's risk model from conventional vendors is how we actually calculate stock exposures to factors. In conventional models, vendors will take the raw factor signals within the risk estimation universe and calculate z-scores that are normalized to estimate the exposure of a stock to a factor. This gives you some sense of where the stock ranks relative to other stocks in the universe on a particular metric. However, it doesn't really measure the statistical relationship between the stock returns and the factor returns. So instead, in our Wolfe QES risk models, we use these z-scores to construct factor mimicking portfolios. These portfolios are long-short, and they're designed to have beta of 1 to the target factor and beta of 0 to the other factors in the model. They're highly diversified and have positions in almost every security in the risk estimation universe. We then look at the performance of these factor mimicking portfolios, and we test to see whether stocks do indeed move with those portfolios or not. We basically estimate the regression betas of stock returns to the factor portfolio returns. We then combine the information we get from the regression betas and the z-scores into a factor exposure that is 75% based on the regression beta or the statistical relationship and 25% based on the z-score or the ranking based on the raw signal data. In addition to giving us more accurate risk predictions, this also allows us to cover stocks outside of the risk estimation universe. So for example, if you own an ADR in your portfolio, and you want to know what your exposure is to a U.S. set of factors, you can simply use that ADR's stock returns and estimate that exposure via the regression methodology. This allows us to cover a much larger universe of stocks within our U.S. equity model, where traditionally in other vendor models, you would need to move to a global model or choose not to model those assets. I'm going to take a closer look at Amazon to illustrate what this exposure methodology does. On the right-hand side of the page, the blue line is the z-score for Amazon on growth metrics. In this case, our growth factor reflects expectations of both sales growth and EPS growth. And Amazon ranks above average, so has a positive z-score on both of those metrics. And you can see that increases a little bit year to date, but that metric is relatively constant through time. Interestingly, however, the beta of Amazon to the growth portfolio actually turned negative in March 2020. And if we take a closer look at sort of the stock returns of Amazon relative to the stock returns of the growth factor, we can understand the intuition behind this. Essentially, Amazon is a company that actually benefited from the coronavirus pandemic in the sense that many more clients demanded home delivery service since they could no longer go to brick and mortar retail. So for Amazon, the coronavirus pandemic was actually a positive story. And so you can see the stock kind of begins to sell off with the rest of the market, but then partway through that sell-off, it starts to rally. At the same time, the growth factor overall sells off, because for companies more broadly and systematically, the implications of the pandemic were putting their growth forecast into question. So at this point in time, Amazon was actually moving up while the growth factor was moving down, and Amazon actually had a negative beta to this growth factor. So you can see that using the beta exposure, while it's more volatile, does give more information about how the stock is actually moving in relation to the target factor, in this case, growth. I want to focus a little bit on our hedge fund crowding and short interest factors, as these are particularly popular within the context of our risk models. First, I'm going to talk about construction and then sort of recent behavior of these two factors. So our hedge fund crowding factor is constructed using quarterly 13F based signals. We create a variety of signals using 13F data, and we look across all of the hedge funds that do submit these filings. We basically aggregate these filings to come to understand what percentage of float is owned by hedge funds, a metric we call intensity, and what the total notional in any particular security is owned by hedge funds. We call this metric level. We combine this information to create our raw signal for hedge fund crowding. Keep in mind that although the 13F data is published quarterly, we're not just using the Z-score of this factor to measure a stock's exposure. We're actually, over time, testing whether that stock is actually continuing to move with the hedge fund crowding factor when we measure its regression beta to the factor, and therefore its exposure. The short interest factor is constructed using daily securities lending data that's aggregated from broker-dealers by market. Specifically, the signal that we're looking at here is utilization, which measures the short positions outstanding relative to the available inventory across broker-dealer platforms. So this data is much higher frequency than the hedge fund crowding factor, and we believe that this represents the short side of equity long short positioning. Of course, we realize there are other investors who do use the single stock shorting market, but by and large, the bulk of this activity we believe to be representative of hedge fund positioning. So both our hedge fund crowding and short interest factors moved very significantly in mid-March, when we know there was anecdotal evidence of broad hedge fund de-risking across the industry. This occurred as broker-dealers raised the cost of financing and VaR limits kicked in, forcing portfolio managers to sell their popular longs and cover their popular shorts due to these catalysts. Hedge fund crowding then dropped as PMs sold their popular longs, and the short interest factor, which is constructed as high short interest names minus low short interest names, rallied as PMs covered their popular shorts. These factors moved together in a very predictable fashion as we saw deleveraging on both the long and short sides of hedge fund portfolios, and they moved very quickly in a matter of 2 or 3 days, having very significant dislocations that also mean reverted very quickly. The hedge fund factor mean reverted quickly and has continued to be range bound for most of the second quarter. Short interest, on the other hand, has continued to be stretched to the upside. Basically, popular shorts are pain trade in the current risk rally. And so as managers cover those shorts, you continue to see sort of pops in the short interest factor, which impacts portfolio risk and return. On the Omega Point platform, we actually can look for securities with significant exposures to hedge fund crowding and short interest outside of the U.S. equity universe. We do have short interest data for securities globally. However, the hedge fund crowding data is 13F based, and those filings are only required in the U.S. As I mentioned previously, we're still able to measure stock exposures to these factors using regression betas. And so here we can see the stocks outside of the U.S. that do have significant beta to hedge fund crowding on the column on the right. And so in this way, we are able to both model these stocks within your portfolio on the Omega Point platform using the U.S. equity risk model, and we're able to search for securities outside of the U.S. equity space that may have a statistical sensitivity to these factors. I wouldn't recommend that a truly global manager use a U.S. equity model, but one of the challenges with conventional vendor models is when you have a portfolio that's, say, 90 or 95% U.S. and it has a small allocation outside the U.S., and traditionally you'd be forced into a global model, or you would be unable to model these assets. Within the Wolfe model, we are able to model these assets using their relationship to the U.S. factors. Here we see the recent performance of both the hedge fund crowding and short interest factors on the Omega Point platform. You can see that both factors moved significantly in the middle of March, with hedge fund crowding experiencing a significant drawdown while short interest rallied significantly. This again representing the short covering of popular shorts and the selling of popular longs. Both of these factors mean reverted very quickly, which means that managers who didn't react didn't see a significant negative impact to returns kind of over the medium term. Some portfolio managers did use these drawdowns and rallies as an opportunity to add to high conviction positions while they were dislocated. More recently, you can see that the short interest factor has rallied again, and this reflects another short squeeze that's occurred as the risk rally has continued and popular shorts have been a pain trade for portfolio managers. We're now going to move on to the analysis of hedge fund 13F portfolios via the Omega Point platform with Wolfe's U.S. equity risk model. Another way we assess positioning of the hedge fund industry as a whole is looking at the aggregate hedge fund 13F portfolio. So instead of looking at the individual fund level, we aggregate all of these 13F portfolios and weight them by the dollars invested across the industry, and feel that that's a representative portfolio of where hedge fund positioning is, at least on a quarterly basis. We can do the same thing on the short side and look at the short interest aggregate portfolio. And actually, if we look at the recent behavior of both of those, we actually see evidence of that de-risking that we believe happened in the middle of March, because we see that both gross notionals on both the long and short sides have come in over that period. We can also see that turnover in the hedge fund aggregate portfolio has been declining in recent years, but it did pick up significantly over the course of the first quarter, given the uncertainty in the market environment. We've sent the hedge fund aggregate portfolio to Omega Point to analyze within the context of their platform, and I'm going to hand it over to Omer to walk you through that analysis.
Ali, thank you very much. Thank you for everyone for spending the time to look at this exciting new innovation on our platform. As we've seen, there's some obviously very unique moves in the markets in the last several months, and by casting a slightly different lens, we can identify potential moves in sort of these portfolios that may not have been sort of triggered immediately in other risk models. That said, using this in conjunction with other risk models, I think, is very powerful as well. What we are seeing here in terms of the recent sector exposures of the 13F portfolio, this is again a 13F portfolio that is, frankly, it's static, right? So inherently we get that portfolio once a quarter, right, when the 13F filings are published. But we can use that to help obviously get positioning data on that particular portfolio in the quarter, at the end of the quarter, and how it trends based on the movements in the factors intra-quarter. What we can see here in terms of positioning is really how much of the risk in that portfolio was spread across the major sort of GIX1 sectors. So here you can see that for the most part, as of March 31st, which is the most recent actual date of the holdings, the biggest risks were coming from, not surprisingly, from the consumer discretionary sector, healthcare, industrials, and information technology. We can see, interestingly enough, based on, again, this is a holdings and obviously being sort of carried forward for a several month period, we can actually see that consumer, the active risk on consumer, spiked up dramatically, while we look at information technology, on the other hand, the active risk went down from about 12% to 6%. Naturally, this has to do with the movement of the securities in the marketplace, but it helps sort of understand how the positioning evolved over that period of time. What's also interesting, and this is really where we jump into how the Wolfe model really looks at these sort of this portfolio. This portfolio naturally has a lot of its risks being explained by factors. So a lot of the movement in the last 3 or 4 months, and we've got 2 snapshots here, again, March 31st and June 8th, show you really the active risk is largely explained by factors, and in fact, it's explained mostly by style factors, right? Where industries really are a much smaller portion over the overall sort of risk characteristic. And in fact, over this period of time when the market, again, continued to evolve between March 31st and June 8th, you can see that style factors have actually increased their overall percentage of risk, while industry factors were lower, but factors in general became more explanatory of the of the underlying portfolio's risk in the market. Now we're going to look at the actual returns of that portfolio over that period of time. So that can give you a little bit more of a sort of a view of the actual trends, right? I mean, risk can kind of give you sort of a point in time snapshot. But from a return perspective, this is what we've seen since basically March 31st through June 8th. And again, not a surprise there. I mean, you saw the risk snapshots of how much of the risk was actually being explained by the style factors. You can see that the returns were commensurate with that. Really a very sizable portion of the returns we're talking about. Obviously, it looks like there was some sort of negative alpha there where you see sort of total returns being 12.7%. But of the factor returns, style factors explained 11 or almost 12% of the 14%. So that was a very, obviously a very large sort of explanatory move coming from the style factors. And we talked about short interest, and this is something that Hallie really sort of honed in on, given that it has been a very an incredibly high performing factor, right? I mean, we saw the very large jump during the COVID period, but most recently we've actually seen a second sort of a rally in short interest. And not surprisingly, if you look at the factors itself, this is what you see here, sort of the winners and losers in this Wolfe factor model. Short interest actually comes up second to volatility, which we know has essentially been the big risk rally in that. Also, sort of interestingly enough, I mean, many of you have probably been following value and momentum in the last sort of month or two, and obviously this is looking back a little bit longer, but you can certainly see momentum being an extremely negative contributor, as well as value starting to be a positive contributor, and that's actually even accelerated in the last couple of weeks. One of the things that I think we demonstrated a couple of slides ago with Hallie is sort of that there's a lot of different views on Omega Point that allow you to be able to take a look at these factors. One of the views that we talk about is sort of security search. Another view is the ability to actually upload that portfolio or a universe into Omega Point sort of as a portfolio with whatever sort of holdings and weights that you'd like, and then be able to look at the individual exposures, both weighted and unweighted in the platform. And here we're just sort of picking out the current highest exposure to short interest. So remember, short interest is not static like the hedge fund crowding, right? This is actually changing every day. So by measuring the exposure of securities to short interest, both from their actual sort of Z-score, right? Their actual raw short interest number plus the regression beta, which allows you to sort of see how well they're trading in sympathy to short interest, might allow you to also uncover securities that have exposure to short interest but are not necessarily popping up or are certainly trading in sympathy with that short interest factor. So you can kind of see within this sort of universe, the large, broader 13F universe, that it's natural. I mean, I think the top 3 names here are all energy names with respect to short interest. So I think you guys have gotten a lot of detail on the model and sort of its usage on the platform. We just want to sort of share a couple of key takeaways here. Really there's the opportunity here to sort of get a little bit of a unique lens, right? I mean, there's a lot of different lenses. There's not one single factor model that's going to tell you the whole story, but this is giving you really a unique lens. I think one that you can use to look at risk across global equity portfolios. It's leveraging an exposure methodology that's very novel because it's leveraging not just standard Z-scores, but also the actual betas of the stocks of the factors. Naturally, that allows you to cover a larger set of securities outside of the risk universe, allows you to think about, gosh, I'm seeing hedge fund crowding in a particular name in China, but I know that it doesn't have a 13F filing, but why is it trading so close to names in the 13F? There's likely some activity in that space, in that name. And so this is the kind of thing where, from our perspective, adds certainly a lot of value to investors who are really trying to isolate positioning and other types of factors that are hard to measure from direct exposures. And we see that in the hedge fund portfolio, right, as taken by a 13F filings at the end of the quarter, that these style factors have essentially virtually explained most of the return and the risk in that portfolio over the last several months. So there's been definitely a lot of factors driving the returns of hedge fund portfolios. We understand that it's been a very highly volatile factor environment, but you can really see how that played into the risk and returns. And then finally, this is just the beginning. And I think Hallie's probably smiling and sort of thinking, we've got a lot more to go here. There is a whole slew of sector models coming your way in the coming months that will involve, technology, media and telecom, industrials, healthcare, so on and so forth. So stay tuned for that. And with that, I'm going to hand it back to Mike.
Thank you very much, Omer. Well, that concludes our presentation today. But if you have any questions or comments about Omega Point or the Wolfe models, please contact either Wolfe Research or Omega Point. Our information is listed on the screen. But today, since we still have Omer and Hallie here, we can jump into some Q&A. It's not too late to submit your questions. Just use the question feature on the lower right side of the GoToWebinar interface. We've already received several of your questions, so let's get started.